Good afternoon, everyone, and welcome to the 12 o'clock slot, where we are joined by the team behind International Biotechnology Trust. Today is all about specialist funds, and until about March last year, biotech was about as specialist as it got. We're all experts in medical science now, of course, but in the next half hour, you'll be hearing from a team with real expertise, not the Wikipedia kind, and led by a former doctor who was once rated by Bloomberg as the top performing biotech manager in the world. Lead manager Carl Harald Janson works alongside Elsa Craig and Marek Poshepczynski to run a portfolio primarily focused on listed biotech companies, many of them developing advanced therapies for rare diseases. Most of these companies are based in the US, but there's a smaller element held in unquoted stocks, and this part of the portfolio is managed by Kate Bingham, whose name you may recognise as a chair of the UK's Vaccine Task Force. Biotech is an area of the market best known for capital growth, but by converting some of that growth into income, the trust is able to offer a yield equivalent to 4% each year, making this an attractive and highly differentiated option for investors seeking capital growth and a diversifier for their portfolio income. It's my pleasure to introduce you to Carl Harald.
Thank you, Pascal, and welcome to this presentation that we called Investing in Biotechnology for a Healthier Future. Next slide, please. Please read the disclaimers and risk warnings carefully. Next slide. The agenda today is displayed here. You will see that we are going to talk about the trust. We're going to talk also about the fundamental drivers of the sector, current themes, and also how we position the investments in the trust for the year ahead. Next slide, please. So a quick overview of the sector. The sector has strong fundamentals driven by things that we're going to talk about a little bit later in the presentation. We have a diversified portfolio investing in both quoted and unquoted company. We give growth and yield to the investor, and we have an investment strategy that is based on bottom up and top down with a diversification. It's run by an expert team, and today you're going to hear three of us speak on this presentation. And it's all about innovation, of course. This is one of the most innovative sectors in the world. Next slide, please. This is the team, and we are already introduced by Pascal, so I will not do that. I will mention that I started in running this fund in 2013. Elsa joined the firm in 2006, Marek in 2014, and Kate Bingham is the founder of SV Health Investors. Next slide, please. So we are part of SV Health Investors. This is a organization with offices in Boston and in London with 50 experienced investor professionals doing healthcare investments, mostly in the venture side. So we have several venture funds, and the SV has managed this biotechnology trust since 2001. Next slide, please. So let's move now to the trust and talk about the performance to start with. On this slide, you can see the annualized NAV result returns for this trust, and it's been 16% since 2013. And you can see that the NAV share price performance has been very strong in 1, 3, and 5 years, also compared to the benchmark, that is the Nasdaq Biotech Index or the FTSE All Share Index. The trust includes an investment in a venture fund called SV Fund 6. That investment constituted 8.5% of the investments at the end of January this year. We also have a number here for the volatility. So this trust had a beta of 0.8 in the 5 years to the end of December 20, as compared to the Nasdaq Biotech Index. So lower volatility than the benchmark. Next slide, please. So as mentioned, the trust has a dividend policy, paying 4% of net asset value as a dividend. This is calculated as 4% of the net asset value at the end of August each year. End of August is the end of our financial year, and the NAV is calculated on that day. Then it's paid in 2 tranches in the following year. The first tranche in January, and the second tranche in August. You can see on this slide the payments that have happened in the last 5 years. Next slide, please. So the portfolio, let's have a look at the portfolio. What have we invested in? And at the end of January, we have a slide here representing various things. You can look at the top right. This is the geographic split. Most of our investments are in the United States and Canada, mostly I would say in the US. And then we have a small part of the investments in Europe. This is because most of public companies are listed in the US, even if they are European. And also the industry is very big in the US, and most of the investment opportunities we find in this jurisdiction. On the right-hand side, towards the bottom, you can see that the area that we invest mostly in is called rare diseases. It's an area where we have very few patients for each disease, but there are many of these rare diseases. Single gene mutation rare diseases have been calculated to be, in the more than 5,000. Oncology, cancer is the second largest area, also an area where we can see large advancements, quick advancements in the treatment of patients, and there are many different tumors that have a high medical need. So if you look to the left, this is the portfolio at the end of January. Top 10 investments constitute 44.2% of the trust. And this is mostly a mix between rare disease area and oncology. You can see that the valuation, the current valuation is to the far right, a forward PE at the end of January. Valuations are pretty modest, I would say, for many of these companies with multiples starting with a 1 in most cases. Some companies do not have earnings yet, only revenue, and there we have an NM instead of it's not measurable. So you can also see that we have a diversified portfolio. We have no real elephants. We try to make a traditional broad portfolio, and of course our biggest bets are the ones that we like most, and Horizon is the largest one at this date. It's a company that has a very good management that has changed the company from a specialty pharma into a more rare disease company, and has now sales for several drugs. The most impressive one that we have seen recently is the one launched last year called Tepesa. It is for a disease called TED, Thyroid Eye Diseases. You might have heard of this disease. Is when you have thyroid hormones are too high. Also, the eyes start to come out of the skull, so to say. You can see the white above and below the pupil, and it's something that, of course, is not very aesthetic, but also has some medical implications on your eyesight, and also you don't feel very well in the eye. Traditionally, it's been surgery to try to fix kind of the eye problem, but this company has developed a drug, and this sales of a drug that is not surgery, is given as an injection instead. So of course, who wouldn't favor an injection rather than surgery on the eye? So the launch has been very good, and we still think there is this drug could have a sales potential of more than is assumed. So in sake of time, I will not go through the whole portfolio, but if you have questions, we can attend those later. Next, move to the next slide. So the investment process overview, we have a more traditional approach. Idea generation, we find out what's out there, what's IPOing, what's reverse merger, what's listed on the various stock markets. We monitor the news flow of these companies, and we check the valuation. We also have valuation models internally to make models of sales and earnings. We have a trading discipline, so if stocks move too quickly, we can take advantage of those situations. And we have a risk mitigation strategy. This sector has, of course, risks, and portfolio construction, having a broad portfolio, can mitigate some of the risk. And we also use a binary event strategy to try to avoid the risk that happens at certain occasions in companies that have a clinical development, have drug in clinical trials, and we kind of avoid those kind of binary events when there is a readout of a very important clinical results. We also have the possibility to do cash gearing, and we have an analytical approach to this where we use the gearing following the market volatility measurements. Next slide, please. Quick overview of the investment process without going into details. Important words for us are single wholly owned assets, a big unmet medical need, a monopoly situation with not too much competition, financially strong companies, a pricing power of the drugs, management, very important to have companies that have good management that are capable of developing these drugs and selling them, valuation, and last but not least, liquidity of the stocks traded on the stock market. We don't like illiquid companies. We invest in liquid stocks as much as possible. Top-down approach, we can do something about our gearing. We can move a little bit into larger and smaller companies, and in such way, adjust the portfolio construction a bit regarding how we think about the market outlook. And we'll hear more about this later on from Marek. Next slide, please. So now I'm going to leave the word to Elsa that will talk about fundamental sector drivers and current themes. Elsa, please.
Thank you, Carl Harald. So as Carl Harald said, I'm going to talk about why this sector has outperformed in the past historically. So biotech generally outperforms healthcare over the long term. It's the fastest growing subsector, and why healthcare generally outperforms the broader equity markets. And we think it's a balance of supply and demand. So this slide, you can see how the proportion of spending in healthcare is made up of the over 55-year-olds. So more than half are spent on this age group. And this makes sense because it's these guys that get cancer and diabetes, and obviously been hit hardest by the recent COVID-19 pandemic. Next slide. And you can see from this slide, this shows that the proportion of over 65s is expected to double. So the proportion of the population is expected to double over the next generation. And so that on the demand side, we're seeing an increase in demand because of this population growth. Turning to the next slide. Now on the supply side, if you remember back in 2000, we had the sequencing of the human genome. And really that was a genesis, if you like, of a huge wave of innovation. And from that, we're seeing increased productivity of the biotech sector. So on the left-hand side of this chart, you can see that the number of drugs in clinical trials is growing over time. So each year, the number of clinical trials is increasing. On the right-hand side, you can see the product of this. So this shows the number of new chemical entities approved by the US regulator, the FDA, over time. And there's a broad trend upwards. And this is supplying more drugs for the needy. Turning to the next slide. This is an external source, Evaluate Pharma, and this shows the percentage growth of drug sales projected into the future. And the expectation is about 7% compound annual growth rate into 2026. But what's interesting about this slide is it shows just how fast a subsector, the orphan disease area, is growing. And that's at low double-digit growth rate, which is why, as Carl Harald said, we have quite a large position within the trust within these rare disease areas. So turning to the next slide, moving on to current themes. We've seen how innovation has been driving sector performance, and this is some examples of bringing some of that innovation to life. So there are 4 examples of what we call platform therapies mentioned in this slide: cell-based therapies, gene therapies, RNA therapies, which you may have heard of, and gene editing. The first 3 have products that have succeeded in clinical trials and are now selling on the market. So these are success stories. This isn't just textbook science, it's actually making products and money. And then beneath the bottom of the slide, you can see some company examples of names that we invested in the trust that have these platform technologies. Now, we like platform technologies because they're not only going to, it's not a company with one drug addressing one disease, but potentially more and more drugs coming into the future. Gene editing at the end, we'll touch on. This isn't necessarily proven yet, so we don't have marketed products within gene editing, but this is a potential future generator of sales. So next slide, please. So moving on to the election, which is now over in the US, as Carl Harald said, most of our exposure is in US companies, and politics and healthcare comes very much hand in hand. Biden is a Democrat. However, the power isn't just left with the president. We have the House and the Senate. And what we're trying to do with this slide is really bring to life how close this election was. The majority win by the Dems was very much razor thin. And the implications of that are that any major legislation changes in the US will struggle to get through. A major overhaul of the healthcare market would be something that would be very contentious, and we don't think it's highly likely because of this razor-thin majority, but also Biden is a centrist. His opponents within the Dem Party for leadership, Elizabeth Warren and Bernie Sanders, were more progressive, and they wanted something called Medicare for All, which would have been an overhaul for the sector, but that now we feel is off the table. So moving to the next slide. What we've done here is listed some of the proposals that the Biden administration has set. If you remember, Biden was part of the Obama administration that introduced Obamacare, which is the US current healthcare structure. So on the left, we've listed some proposals that he's mentioned. In the middle, the likelihood, we think, of them being passed. And on the right-hand side, whether this would be a positive or negative impact on biotech. I'm pulling out the most contentious one. This would be Medicare drug prices. So as we've seen, it really has been innovation that has got the world almost out of this pandemic with various different approaches, which I'll come on to shortly. So it's unlikely that the US administration are going to come down on anything within the industry that might stifle innovation, and monitoring or controlling drug prices would definitely do that. So we think the administration's focus will be trying to improve the efficiency of the sector by increasing the number of patients on generics, for example. So moving on to the next slide. Under the new administration, how have we changed our approach within IBT and our stock selection? We will continue to favour, so no major changes, innovative biotech companies that address an unmet medical need, drugs that have patent protection and potentially that the company wholly owns. It doesn't necessarily have to wholly own the drug, they can be partnered, but it's great if they do. It's great if the drug addresses a disease area with a monopoly position. All of these factors help pricing, and that the drug is de-risked. So Carl Harald mentioned we like to reduce our exposure within the fund to any exposure to clinical trial outcomes or regulatory events where you could lose a lot of money. Equally, we're going to continue to avoid companies invested in generics or drugs that are growing slowly and established, or drugs that are approaching a patent cliff, or so-called Me Too drugs, so something that isn't that differentiated. So finally, turning to the next slide, this touches on COVID-19 and how the industry has played a role. So I think from every step of addressing this pandemic, biotech has played some significant part. First of all, it was identifying what this virus is through gene sequencing. And that is an ongoing effort as we see new variants come up. We've seen a global cooperation between biotech and pharma, for example, BioNTech partnering with Pfizer, Oxford partnering with Astra. So a really great global cooperation. We've seen some successful treatments, but room for improvement on that front. And the real success story has been the vaccines, very highly effective and so far safe. So that's been a huge success. So it's been a great story, the COVID-19 approach, and everyone I think is incredibly proud of the effort globally. So I'm now going to turn over to Marek to continue with the rest of the presentation.
Thank you, Elsa. And I will discuss the positioning for the year and how 2020 was for International Biotechnology Trust. So if you change slide, you can see think this is an important slide showing the upcoming major sector events in the biotech sphere. And Biogen on the left-hand side, this is a graph of the share price over the last 2 years. You can see the volatility. And this is how International Biotechnology Trust operates. We do not tend to take these binary risks going into certain events. And Biogen's Alzheimer's approval, which will be in the mid-year this year, it will be decided by the FDA. And we will not take any major bet on this because we cannot second guess what the agencies will do. And there is a lot of political capital that will be discussed amongst them. But that's one of the major events this year. On the right-hand side, you can see that Gilead Immunomedics was acquired by Gilead, a big behemoth and one of the largest biotech companies in the world. And they acquired Immunomedics a couple of months ago, and we'll see additional breast cancer data that will decide if Gilead is a good acquirer or if they have not done the best deal and diligence as you can expect from these guys. When it comes to Amgen and Mirati, we have interesting lung cancer data coming out from these two companies going head to head. Going down the list, I want to show that hemophilia A in gene therapy will show 2-year data, which will be very important. One of the first data sets that might render an approval. Hemophilia A is to some extent very devastating disease. Patients, primarily kids, need to infuse 3 times a week. In this particular instance, they can be cured from this disease. And CRISPR, a gene editing technology, will see the first set of clinical data. Remember, this technology got the Nobel Prize last year, so it's very interesting technology and can revolutionize biotech. Change the slide to the next one. You can see also that M&A, mergers and acquisitions, is a major theme in the biotech industry. I would like to point out that, as Elsa pointed out, we have had an explosion of innovation, new projects coming in during the last decade, and we also see the increased M&A depending on that, because there are basically many new opportunities coming up. And since 2014, we have seen a lot of activity. 2019 culminated in the Bristol Myers Celgene acquisition, and 2020 started off in a fantastic way, but was interrupted by the COVID pandemic. It resurged to some extent during the summer and later in the year, but with the second shutdown, we have seen less activity, but we don't see any reason why this shouldn't continue on in the long term. This is an integral part of the industry. If you turn to the next slide, you can see that this is a portfolio of companies or companies that have been acquired at the time International Biotechnology Trust held them in their portfolio. And having said that 2020 was a moderate year, you can still see that 4 companies were acquired where we had held them in our portfolio. And of recent, we also have added GW that have been acquired by Jazz Pharmaceutical. As you can see, the average premium during this period has been around 70%, which is a very good contribution to the performance we've had over the last couple of years. We change the slide. I want to summarize 2020 to begin with. We had a fantastic 2020 despite the pandemic. We navigated the COVID pandemic in the beginning of February. We started to sell down our riskiest positions. By April, we started to redeploy money. We saw that a lot of companies being undervalued, and we carried on until, I would say, the election time frame, where we started to see evaluations being a bit over the top and a bit hot, especially after the Democrats won the election and we had the additional Senates won by the Democrats. So going forward, we see some signals of this frothy early stage companies, the meme and theme names, where we have chosen to stay away from. Not saying that a lot of these companies will succeed in the end, but there is a limit to how much you're willing to pay for the privilege of owning them. We see a lot of opportunities in the mid-stage. As Carl Harald pointed out, to the top 10, a lot of mid-stage companies with fantastic growth potential still have P valuations that are very attractive going forward. Also, the larger companies may so be not the growth intense ones, but they generate a lot of cash, and it's a nice anchor in our portfolio. So how we view it is that we have the big, large companies generating a lot of cash into our portfolio, which is an anchor. Then we have a portfolio with the mid-sized companies which offer a good growth. And then on the smaller size, we look for nice growth and innovation stories, as pointed out before, the technology platforms, which we find some of them undervalued. And M&A is always a theme here. So the big companies have a tendency to merge with each other if the valuations go too low. But I will show that in the next slide how the valuations and relative valuations have moved during the last year. If you please change the slide, and I will come to that. On the left-hand side, you can see the S&P 500 from 1st of January in 2020 until the end of January. You can see the S&P 500 performed very well. Nasdaq Biotech Index, which is the market-weighted biotechnology index, which is our benchmark, has moved very nicely as well, and we have benefited from that. But as you also can see, the XBI, which is the equal weighted index, meaning it has a preference toward the small caps, have had an extremely good run from the election timeframe until of recent. We find that run really interesting because fundamentally maybe it doesn't hold as much as it held earlier in the year. And as you can see on the graph, that index is up 60% in a year despite the pandemic. On the right-hand side, you can see the large caps, which over this time frame have generated an increased revenues and earnings, have despite that have p-valuation coming down and are between 10 and 15 at the moment. So we feel fairly confident investing in them and maybe not having them as a value trap, but very solid base cash flow generating. And as always, when we think about it, risk mitigation, and earlier in the discussion we had that our beta is lower than the index in itself. We want to be slowly moving and increasing value over time without taking too much risk with our exposures. So with that, I will leave to Carl Harald to conclude the presentation and open up for questions.
Thank you, Marek. Also, I won't summarize the presentation once again. I guess I'm just going to say towards the end here that this sector has been put a little bit more in the spotlight during the COVID pandemic. So I think it's more appreciated now that there is a sector here that is constituted of new and upcoming young biotech pharmaceutical companies with new products in the new areas with new technologies. And we've been through the whole presentation to look at the various characteristics of it, and I hope you appreciate it. I think we could just move to the questions right now and see if we can get the discussion going here.
Yeah. Hi guys. So we will start, I think, with a pretty straightforward one, which is why are biotech stocks cheap relative to the market at this stage, given the huge interest the world has in biotech at the moment and the fact that they've come, forward since last year? Why are they still cheap?
Maybe I could start with that one. Then it's why they're cheap. I think one has to look back a little bit into the history of the sector, and if you take a look at a longer graph of the Nasdaq Biotech Index, for example, that is a proxy for the sector, you can see that it peaked in 2015 after a very, very strong run, and then with that election, Hillary Clinton versus Donald Trump, there was a lot of a discussion about the high drug prices in the US. I don't know if you remember, Hillary Clinton tweeted about price gouging and these things. So and the sector had a good run. So I think then it cooled off a bit for a few years. There's been more discussion about drug pricing in the US and various things. So if you look at on the such graph, it has kind of consolidated, and So that's why we think, as a whole, it is relatively okay valued. But then Marek has clearly explained, that the sector is bifurcated, or the various parts of the sector that have more the small cap sectors that had a wild ride, while larger companies with earnings more traditional have not had that incredible increase in valuation. And this is not the first time in history that we can see this type of discrepancies. If you remember, 97, 98, 99, and 2000, we had, in the beginning, pharma companies going up, and then you had biotech was cheap, and it was vice versa. So these things can happen. You just have to follow them. Marek or Elsa, would you like to add anything?
Yeah, I think that covers it really well. It's been an election year. Biotech tends to, or healthcare generally tends to be out of favour, as Carl Harald said, in those times because of the drug pricing issue. But there are pockets that have participated in the recent rally.
Great stuff, guys. Okay, just more questions on valuation and kind of recent events. The trust obviously has seen steady growth over the long term. Do you think the last 12 months are likely to be repeated because there's more of a kind of growth imprint than there has been over the longer term, or do you think it's a 1 year special caused by what's been going on in the world?
I can take that. I mean, the last year, 2020, I think everyone can agree it has been a very special year. We came into 2020 with a positive view of how the market would perform, and as Carl Harald alluded to, the biotech sector were very relatively flat for 5 years, and then the pandemic hit, interest rates went down, and as you can imagine, smaller companies tend to be more interest rate sensitive, and this is what kind of have driven the market during the last 3 to 6 months, that the risk on is to some extent driven by macro forces, the liquidity in the markets, and we have to navigate in this environment. The biotech is just a part of the major big markets, and we have seen a lot of these meme and theme stocks moved very high, but it's only a small sliver of that market that is overvalued. But we think long term, as Carl Harald alluded to, we have had like 10 to 15% increase on an annual basis for the last, I think, 20 to 30 years. So over long term, this will carry on, we believe.
Thanks, Marek. A question sticking with risk and how you manage risk, and I think it's a really interesting question for people who don't know the trust that well, is you've mentioned the sort of binary risk avoidance strategy where you sell out of companies as they approach binary risk events such as I think third phase trials. It's probably one of the things we talk about there. Obviously that means you might miss out on some of that growth if things go well. Can you describe why that exists and how it works and whether it restricts your ability to take that top slice of growth?
I can take that. Yeah, so as you've touched on, Pascal, that's exactly right. So what we try and do, and this isn't something that's foolproof, obviously things and events can happen that are unpredictable in their timing. But what we attempt to do is monitor the news flow of our companies really, really closely so that we know when to expect clinical trial readouts or PDUFA dates, which is the approval dates from the regulator. And then we'll reduce that position within the fund. So take down that exposure within that company. However, there are some exceptions. So if the company is a large company, these are quite unusual events, such as Biogen. We've got a big binary event coming up with Biogen, a PDUFA date. It's a big part of the index, and we will neutralize that position. It's a slightly one-off situation. If it was a smaller company, we would just exit completely. So that's our approach. And then we would invest back after the risk event has passed. And that may mean that it will be a more expensive, in inverted commas, investment, But in our view, it's less expensive when you adjust it for risk. So we would rather pay more for a de-risked asset. And we're seeing behavior similar for big pharma who are looking to acquire biotech names, which is something that goes on all the time year on year. They also want de-risked assets, and they are willing to pay more for a proven clinical trial outcome. And we've seen examples within the fund, like Pfizer, when they bought Array, they bought Array after the data readout. And this saves face, really. You don't want to invest billions of dollars in buying a company for a clinical trial to fail. So many of our companies get picked up by big pharma as a result. We look for the same characteristics and attributes in a company as they do.
Thanks very much. There have been quite a few questions about individual stocks, and unfortunately, for compliance reasons, we can't really ask those questions and or provide answers to them. So I'm sorry if you've asked those questions, but that's why we aren't asking them on your behalf. Okay, so probably the next one is to talk about the income from the trust. That's something that obviously is quite unusual in the sector. That's paid from capital, I think, is the case. Can you talk about how that works, what that means, and what the kind of implications are for long-term growth, given that some of that must be used to support that income?
Okay, I'll answer that. So we pay 4% of as a dividend. Now this hasn't happened it started in 2016 for the first time. Since this sector usually correctly, from these questions, that usually companies don't pay very much dividend. They are growth companies or have, some of them have dividend, but the majority will not have a dividend. So how do we create the dividend? Well, it is paid out of capital. It's paid out of capital reserves. And there's plenty of capital reserves since this trust started in 94. Now, the question on, the durability in the future of paying out a dividend of 4%, needs to be addressed, of course. And when this was decided by the board, if what percentage would be, we looked at the long-term growth of the sector historically, so what's happened in the future, what's going to happen in the future, we have, of course, no idea about. But if you just look backwards and you look at the growth of the sector since it started, and you use the Nasdaq Biotech Index as a proxy for the sector, you can go back to 93, and I'm actually having the Bloomberg screen to the right of me. I can read here that from 93 to today, the Nasdaq Biotech Index has appreciated 13% per year. So it's in that ballpark, let's say 10% or so historically, 10 to 12 to 13, depends on the cutoff dates. But then if you subtract 4% of dividend from that historical growth, then you still have a big proportion of capital gains remaining in the equation. So I think that's how we thought about it, and also looking at kind of the future that Elsa has been through, the demographic shift and kind of the new products that are arriving to the market, generating new sales. We think that we will not run out of money to pay the dividend in the short to medium term anyway. What's going to happen in the very long term, nobody knows, of course, but I hope that answers that part of the question.
Yeah, I think so. Question about the geographical allocation of the trust, and obviously you said a lot, most of it is US based. Can you talk about why that is and explain whether that is a deliberate thing, as in you've chosen the US specifically, or whether there are reasons why it's so exposed to the US?
Yeah, I can take that question. To begin with, I think that the US market is where the financing of the biotech sector is. We have the Boston area and you have the San Francisco, very similar to the Silicon Valley. And having said that, majority of the large caps are listed in the US, but you should know that many of the European companies, they have a very good scientific backgrounds and good development, but once they reach a certain maturity level, there are so much incentives to move either the company or the listing to the US. So this is what happens. So if we, in our portfolio at 96% or whatever it was in US listed, you can probably deduct a lot of that, because many of them also called ADRs, they are listed in the US but originate in Europe. So that is the reason why. there is a lot of capital in the US basically, and this is how the tradition has been.
Okay, thank you guys. One of the things you talked about during the presentation was the age demographic of the world and the doubling of people aged over 65. And one of the questions is there any kind of change in the way you're managing the portfolio that reflects that? Are you doing anything to target companies which specifically benefit from that change?
Yeah, I think I can take that. I absolutely. So as you mentioned, it's these guys that mostly get cancer, unfortunately. As you age, that's one of the diseases that is more likely to happen to you. And we specifically like that space because it's an unmet medical need. And that's what we will focus on because that's where you have price controls. So business as usual, as I said, the supply and demand is the driver of the sector performance. We're going to continue to invest in that area.
Thanks, Lucy. Elsa, sorry. Why are rare diseases so important, and what makes it an attractive area for you?
I can take that in as well. So we like the characteristics of rare diseases. This is the same as orphan diseases, and examples can be things like cystic fibrosis or Duchenne's muscular dystrophy. And this is an interesting area from an investment perspective. Why is that? That's because the population of these diseases tends to be quite small. So this isn't an aging population. They tend to be young. The diseases tend to be very severe. You're born with them effectively. It's a genetic issue often. And ultimately, that means that the clinical trials themselves will be pretty small, so that they're cheaper to run. The diseases are very well understood, and the clinical trials are often very short. So the time it takes from an idea to a product on the market is much shorter. It's much cheaper to get there. And then the pricing power on the other side of it is incredibly strong. So because it's such a small patient population, prices are high to counter the fact that there aren't very many patients. And that's a deal that society has made with these particular developers, because otherwise no one would be incentivized to make drugs for this market. So for all of those reasons, we like it. As you saw in the presentation, sales projected growth is expected to be low double-digit going forward. So we have a decent proportion of the trust within these names, and we're likely to continue to do so.
Thanks. A couple of questions about the kind of more mechanical aspects of what you do. Can you talk to us first of all about gearing and how you use that, what it is at the moment, and what the kind of view on it is?
I can take that one on gearing. So we can think about it from a prospectus point of view. I think it says we can gear up to 30%. We wouldn't do that. The board has given us the mandate to gear up to 15%, 15% max. And the reason is that if we would be maximum geared and the market would collapse, we wouldn't breach any margin. So we kind of currently we are not very much geared. We think the market had a strong run, and the VIX that we use as the volatility market characteristics that we follow has come down pretty much. So and you really don't know what's going to happen with this pandemic. It's there are vaccines, but there are many things that are relatively uncertain. So we haven't really used the gearing very much currently. We were geared before the pandemic. We have written about that in our monthly. And then when the pandemic hit in Wuhan, we thought, when they were actually, welding doors and, closing down, and we could see some cases in the rest of the world. And having read this book about the pandemic that came out years ago, the influenza, we really thought, this doesn't look good. And we sold down the gearing and went into 5% cash approximately. So, and then we were not hit that hard by the down in March. But I mean, that's where we are between, let's say, 5 cash, 15 max, and most of the time we'll be between 0 and 5% geared, I would say.
Thank you. And can you tell us about the currency hedging you use, if any, with your US dollar exposure?
Quick answer is no, we don't hedge the currency. So it is kind of the full exposure to the US. But on the other hand, think about the healthcare market as a global market. So a company that is listed in the US selling drugs usually sells these drugs globally.
Thank you. I'm sorry if you've not been able to reach all of your questions today. That's all we've got time for in terms of Q&A. But do be assured that anything that's been submitted will be passed on to the team, and we will do our best to get back to you with an answer. Thank you, everyone in the audience, for joining us. We're going to be joined by BlackRock Oil Mining in 15 minutes, and I hope we'll see you there. If you're not registered yet, you can. You'll find an article on the homepage to do so. In the meantime, thank you, Carl Harald, Elsa, and Marek, for taking the time to talk to us. And have a great day, everyone.
Thank you, Pascal.